Welcome back to Books to Riches. Today, we're diving into Lowell Miller's The Single Best Investment, Creating Wealth with Dividend Growth.
hmm
Basically, it's all about practical strategies to reach financial freedom. So let's just jump right in. You ready to unlock the secrets to building wealth?
Absolutely. This deep dive is all about extracting actionable advice you can use. We'll unpack the core concepts and get you thinking about how to apply them to your own financial journey.
Okay, let's unpack this. Right off the bat, Miller challenges a common belief about bonds. He argues they're not the safe haven many believe, especially with all this inflation. He even goes as far as calling bonds a bad investment. I have to admit, this is a bit of an eye-opener for me.
Many people consider bonds a cornerstone of a balanced portfolio, but Miller presents a compelling argument against them. He illustrates this with a real-world example. Imagine saving $10,000 in 1945 for your child's college education, thinking you're being responsible by putting it in bonds.
But by the mid-1960s, that $10,000 barely covers a single year of tuition because of inflation.
Exactly. Bonds often fail to outpace inflation, meaning your money is actually losing purchasing power over time. It's a slow but steady erosion that can significantly impact your long-term goals.
So instead of fixating on fixed income, Miller urges us to embrace the concept of bouncing principal and the potential of long-term growth. In particular, he champions the power of compounding, calling it the eighth wonder of the world.
And for good reason. Compounding is essentially earning interest on your interest. It's about reinvesting those earnings to create a snowball effect. To see this in action, consider a simple example. $1,000 invested at a 10% annual return. Over 20 years, with compounding, your initial investment would grow to over $6,700. But with simple interest, you'd only have $3,000. That's the power of compounding in action.
Wow, that's a huge difference. It really highlights why compounding is so crucial for building wealth over time. It's not just about saving, it's about making your money work for you.
Precisely. And Miller's book is all about harnessing this power to build your own private compounding machine. He believes the key is focusing on high-quality, high-yield stocks with consistent dividend growth. He argues that dividends represent real cash flow and offer a reliable indicator of a company's financial health.
Okay, so instead of just chasing the next hot stock, you're looking for companies that are consistently profitable and sharing those profits with their investors through dividends. That makes sense. But how do you actually find these single best investment stocks, as Miller calls them?
He outlines a multifaceted approach. First, focus on companies with strong financials, including low debt and consistent earnings growth. Think of it like buying a house cat. You wouldn't want one with a shaky foundation, right? You want to own a piece of a financially sound business.
That makes sense. But he also talks about understanding the story behind the company. What does he mean by that?
He's emphasizing that it's not just about crunching numbers. It's about understanding the company's narrative, its future prospects. Look for businesses with a history of smart acquisitions and a management team that has a proven track record of delivering value to shareholders.
So it's about looking beyond just the current financials and trying to assess if the company has a solid strategy for future growth. That's where it can get a bit tricky for someone like me who isn't a financial expert.
And Miller recognizes that. That's why he introduces the concept of a growth kicker. This is a catalyst that propels a company's earnings beyond its normal growth trajectory.
Okay, so what are some examples of these growth kickers that we should be on the lookout for?
Well, it could be expanding into new markets, developing innovative products or services, strategic acquisitions that boost market share, or even share buybacks that increase the value of existing shares. It's about identifying those companies that are not just standing still, but actively pursuing opportunities to expand their profitability.
That's incredibly helpful. So it's about understanding both the company's current financial strength, A and D, its potential for future growth. You're essentially trying to predict which companies are going to keep getting more and more valuable over time.
Exactly. It's about finding companies with a compelling story, backed by solid financials, and then letting the magic of compounding work its wonders.
But I'm guessing it's not as simple as just picking any company that pays a dividend. How do you know if a dividend is reliable or sustainable?
That's where analyzing a company's payout ratio comes in. This is the percentage of earnings that are paid out as dividends. A high payout ratio, like anything above 60%, could indicate that the company might be stretching its resources to maintain those dividend payments. It doesn't necessarily mean it's a bad investment, but it's a sign to investigate further.
So you want to make sure those dividend payments are coming from a place of strength, not desperation. But even with a solid payout ratio, what are some other red flags? That might signal it's time to sell a stock.
The most obvious sign is if the dividend itself is in jeopardy. If a company cuts or eliminates its dividend, that's a major warning sign. It could signal financial distress or a change in management's priorities, priorities that don't align with shareholder value.
That makes sense. A sudden change in dividend policy can be a real gut punch for investors who rely on that income. What about a gradual slowdown in dividend growth? Would that be cause for concern?
Absolutely. Remember, we're looking for companies with consistent dividend growth. If that growth rate stalls or significantly slows down, it could indicate that the company's future prospects aren't as bright as you initially thought.
So even if they're still paying a dividend, it's not necessarily a good sign. You're looking for evidence that the company is continuing to grow and share those profits with investors. But what about the opposite scenario? Let's say a company's stock price skyrockets and its yield becomes much lower than other potential investments. Would that be a reason to sell?
That's a bit more nuanced. Sometimes a stock's price can get ahead of itself even if the company is still performing well. In those cases, taking some profits off the table might be a wise move, especially if you can reinvest those funds into a company with a more attractive yield and growth potential.
So it's all about relative value. You're constantly evaluating your portfolio and making sure that every holding still aligns with your investment strategy. That's a lot to keep track of.
It can be, but it's an essential part of being a successful investor. And Miller emphasizes the importance of staying disciplined throughout the process. He cautions against reacting emotionally to short-term market fluctuations or getting swept away by the constant chatter of the financial world.
I think that's one of the biggest challenges for investors, especially in today's fast-paced information overload environment. It's easy to get caught up in the noise and lose sight of your long-term goals.
Exactly. That's why Miller advocates for cultivating a landlord mentality. Think of your stocks as income-generating properties. A responsible landlord wouldn't sell a property just because its value dips slightly in a down market, would they?
Not if that property was still generating consistent rental income.
Yeah.
So you're saying we should view our stock holdings with the same long-term perspective.
Precisely. Don't let short-term market noise distract you from your investment strategy. Focus on finding quality companies with consistent dividend growth and hold them for the long haul.
So you found these amazing companies, and you're committed to the long game. How do you actually go about building a portfolio that maximizes your potential for wealth creation?
Miller provides some practical guidance for constructing a well-balanced portfolio using his single best investment principles. First and foremost, he stresses the importance of diversification.
Diversification.
Right.
We've all heard that before. Don't put all your eggs in one basket. But how does that apply specifically to Miller's strategy?
It means owning stocks across a range of sectors and industries. This helps to mitigate risk because if one sector struggles, others might perform well, creating a buffer for your portfolio. But remember, every stock you choose should still meet those core SBI criteria: high quality, high yield, and high dividend growth.
So you're spreading your investments across different industries, but you're still sticking to those core principles. You're not just buying any stock that happens to be in a different sector. It has to meet Miller's criteria for quality and growth potential.
Exactly. And when it comes to the number of positions in your portfolio, Miller suggests aiming for at least 30 different stocks.
Wow, 30. That seems like a lot to manage.
It might sound daunting, but it's a way to ensure true diversification and reduce the impact of any single stock on your overall performance. If diversification with that many stocks is challenging, he suggests aiming for at least 15 to 20 positions as a starting point.
So find at least 15 to 20 companies that fit his single best investment criteria, spread across various sectors. And you've got a good foundation for a solid, diversified portfolio. But how much do you actually invest in each of those companies?
Miller advocates for equal dollar weighting. This means allocating the same amount of money to each stock, regardless of its price per share.
So you're not giving more weight to a stock just because it's more expensive. It's about treating each company equally in terms of your initial investment. But wouldn't that mean constantly rebalancing your portfolio as stock prices fluctuate?
It does involve some periodic rebalancing, but that's a good practice anyway to make sure your portfolio stays aligned with your investment strategy. Equal dollar weighting helps to prevent overexposure to any single stock and ensures that your portfolio is truly diversified. It's about letting the power of compounding work its magic across a broad range of high-quality investments.
That makes a lot of sense. But I'm wondering, is this strategy suitable for everyone? What if someone needs to withdraw income from their portfolio to cover living expenses? Would this approach still work for them?
It can. Miller acknowledges that some investors might need to prioritize income generation over aggressive growth. In those cases, he suggests tilting the portfolio towards higher-yielding stocks. You might sacrifice some potential for capital appreciation, but you'll create a more consistent income stream to help cover those expenses.
That's a really important point. This strategy isn't just for people who are decades away from retirement. It can be adapted to meet the needs of investors at various stages of life. But, I have to admit, I can be a bit skeptical sometimes. Is there any evidence that this approach actually works? Does the data back up Miller's claims about the power of dividends?
You're right to question and look for evidence. Blind faith is never a good investment strategy. And what's fascinating is how much research actually supports the effectiveness of focusing on dividends. For example, Jeremy Siegel, a renowned finance professor at Wharton, analyzed over 2 centuries of stock market data for his book, Stocks for the Long Run.
Wow, 2 centuries. That's going way back. What did he find?
His research revealed that, over the long term, high dividend stocks actually outperformed low dividend stocks. And it's not just Siegel. A study by John Grant, a respected investment manager, found that portfolios emphasizing high-yield stocks consistently beat the market from the 1970s through the 1990s.
So it's a pattern that's been observed for decades, not just a recent phenomenon. It's pretty compelling evidence. But is there a catch? Are these high-yield portfolios riskier?
That's what you might expect. But Grant's research found that these portfolios actually had lower volatility than the overall market. They delivered higher returns with less risk, which is quite remarkable.
Okay. Now that is really interesting. Higher returns with lower risk. That almost sounds too good to be true. What about more recent research? Does this pattern still hold up?
It does. Even Nobel laureates Eugene Fama and Kenneth French have weighed in on the subject. Their research, published in the prestigious Journal of Financial Economics, found that dividend yields are a strong predictor of future stock returns. And here's the kicker. They found that the predictive power of dividends actually increases the longer you hold those stocks.
So it's not just about picking a stock that's paying a high dividend right now. It's about finding companies that are consistently increasing their dividends over time. The longer you hold those companies, the more likely you are to outperform. That aligns perfectly with Miller's emphasis on patience and taking a long-term perspective.
Exactly. It's not about chasing quick profits. It's about building wealth steadily and sustainably. And to further reinforce this point, researchers at Purdue University developed a model that specifically incorporated dividend increases as a key factor.
I'm really curious to hear about this. What did their research reveal?
Their findings were significant. They concluded that dividend increases are a powerful indicator of a company's intrinsic value, even beyond traditional valuation metrics.
Yeah.
And what's even more compelling for investors is that their models showed that focusing on companies with growing dividends significantly reduced portfolio volatility.
So we're not just talking about potentially higher returns. We're talking about smoother returns, a less bumpy ride. That's got to be appealing to investors who are worried about market swings.
Absolutely. And one final piece of research I want to highlight is a fascinating study by Dennis, and Sarin, published in the Journal of Financial and Quantitative Analysis. They explored the signaling effect of dividend changes.
Signaling effect. I'm intrigued. What did they discover?
Their research revealed that when a company raises its dividend, it often triggers a positive stock price reaction, especially among investors who prioritize high-yield stocks. It's as if that dividend increase is a signal to the market that the company is confident in its future and its ability to generate cash flow.
It's not just about the dividend itself. It's about what that dividend represents. A vote of confidence from the company's leadership.
Precisely. And this signaling effect has been observed across different time periods and market conditions, suggesting it's a fundamental principle of investor behavior. Companies that consistently reward their shareholders with growing dividends are seen as more likely to deliver long-term value.
So as we wrap up this deep dive into Lowell Miller's The Single Best Investment, it's clear that his strategy isn't just a hunch or a personal preference. It's grounded in sound financial principles and backed by decades of academic research and real-world evidence. It's about shifting your mindset from speculation to ownership, from chasing short-term gains to building a portfolio of high-quality companies that can compound your wealth over time.
And perhaps most importantly, it's about empowering yourself to make informed investment decisions. It's about taking control of your financial future and building a path towards lasting financial freedom.
That's an inspiring message. But Miller's book is just the starting point. It's up to each individual to do their own research, understand the risks involved, and build a portfolio that aligns with their unique financial goals and risk tolerance.
Absolutely. There's no one-size-fits-all approach to investing. But Miller's strategy provides a powerful framework that can guide you on your journey to financial success.
Well, this has been an incredibly insightful deep dive. I feel like I have a much better understanding of how to apply Miller's principles to build a portfolio for long-term wealth creation. What stood out to you from our conversation today?
For me, it's the overwhelming evidence that supports the power of dividends. It's not just a theory. It's a time-tested strategy that has consistently delivered results for investors who are patient and disciplined.
That's a great takeaway, and for me. It's the reminder that building wealth through dividend growth is a marathon, not a sprint. It requires a long-term perspective, a willingness to ride out market fluctuations, and a commitment to consistently reinvesting those dividends to fuel the power of compounding.
Now, here's a final thought to leave you with. Miller focuses primarily on publicly traded stocks. But could you apply these same principles to other asset classes? What about real estate, for example? Could you build a private compounding machine through rental properties that generate consistent income and appreciate over time?
That's a brilliant question. It opens up a whole new realm of possibilities for applying Miller's core concepts to different investment strategies. Thanks for joining us on this deep dive into the single best investment. We hope you found it informative and inspiring. Until next time, happy investing.